So, the topic of today is who decides how many rupees exist. Now, this topic comes in from a request from one of my best friends, Himanshu Chopra, who in the previous video wanted to understand how RBI decides how much money needs to be printed and how RBI prints money, right? So, the process of RBI printing money is quite different from RBI creating money. RBI doesn't create money, it prints money. And how it does it, it's not a particular formula or maybe a number, it is a careful data driven process that balances the economic growth, the inflation in the country, and how much currency needs to be flowing in the economy to make sure that the financial systems and the economic systems are financially stable. So, can RBI just print more money without any solid foundation? A common assumption is RBI can simply one day wake up and decides to print 5 lakh crore whenever they need. They could use that currency supply for political will or just for the convenience. But the number of how much the currency needs to be printed, it's not that simple. Why? Because it could have adverse situational circumstances ahead of that. See, gold is worth something. Why? Because its supply is finite. Let's imagine a scenario in which gold has an unlimited supply. It loses its value at that particular time. Because gold can be produced whenever in how many quantities wanted, and it can be used anywhere. See, I'll give you an example of a plastic bottle. We buy plastic water bottle for 20 rupees, maybe 10 rupees. We use it and throw it. Why do we use it and throw it? The reason is because plastic bottles can be recycled or maybe new plastic can be created as much as we want. There is no physical commodity that is breaking that flow. First of all, it can be recycled as well. It can be created new, right? So the finite value of any particular commodity thing and even currency actually makes its value. If we without any backing keep on printing money, the finite would be considered infinite. The currency, the 10 rupee note, the 100 rupee note that we are currently holding loses its value. And that's what happened with Zimbabwe and Venezuela, right? These are the most recent situations that makes our mind to stop just recklessly printing money. Printing more money without economic backing doesn't create wealth, it just destroys the value of the existing money. See, money is, as we have understood in the previous videos, provides liquidity. Cash provides liquidity. An analogy could be body surviving through blood, right? The blood needs to keep flowing in the body. In the same way, money should be keep flowing in the economy for it to sustain. What too little money would create is you won't have a physical currency or maybe digital currency in order to buy things that you need. Let's say you have $10 million lying in your bank account and you want to buy a bottle worth 10 rupees, but you don't have the cash or means to have that transaction. That transaction would fail. So that's what too little money does. And what too much money does, for the same money, for the same goods, prices will rise up. The bottle of water worth 10 rupees could be sold for 20 rupees because everyone has money. You might have more money than someone else, but there's bound to be someone who has more money than you. But what is that money worth? If everybody has more money than everyone, then what will happen is the value of the commodity that you need to buy ultimately inflates. The value remains same, but the prices inflates, right? So what RBI's core goal and mandate is to make sure that the healthy amount of currency is flowing without triggering inflation. Is printing money equal to creating money? RBI prints money, but does it create money as well? From the printed money that exists in the economy? No. See, talking about physical notes, these are something that you can hold in your wallet. They are visible and tangible. And it actually is a very small fraction of India's total money supply, because your bank account is currently holding maybe tens of lakhs rupees, right? But those are just a digital number. The cash in hand, the something that you hold in your wallet, is actually the money supply. You don't use that number in your bank account. You can use it through digital UPI balances, digital wallets, but again, that is also an exchange. You hold money in your savings and fixed deposit, and you have existing number new deposits that are created electronically in forms of loans. The majority of the money in India exists as a digital entries in bank ledgers. You get a loan from a bank in your bank account, you make a payment to some other person, that number is just existing electronically. You just don't need physical currency for that to happen. If you are withdrawing money in form of loan from a bank, that's where the supply of money is needed, that is controlled by the RBI. So printing money is not creating money. So most money is created through bank lending, not through the printing press, right? So again, back to the question that my friend asked: how RBI estimates note requirements? It is first of all dependent on the economic growth, that is the GDP of the company. See, what is GDP? It is a function of consumption, it is a consumption of investments, it is the consumption of government spending, it is the function of exports minus imports, right? This is what it is. Now, if the consumption increases, the investment increases, government spending also increases, and we are a net exporter, what will happen? The GDP increases, the economy expands, because there is a higher flow of money that is needed for these transactions to happen. That's where RBI comes in and makes sure that these indicators, the economic indicators, are happening. See, if the consumption increases, the bank will come in and make sure that there are sufficient cash flows in the economy. If businesses need investments, they'll make sure for all the transactions to keep happening, there is those physical currency that exists. To make sure that the currency is in circulation, RBI tracks exactly how much cash is already flowing through the economy, and it creates a baseline. One of the major reasons why RBI is constantly printing money is to replace the damaged notes. We are having paper notes in circulation. Those have a nature of getting degraded, not degraded but damaged, right? So in order to replace those notes, RBI is continuously printing money. See, seasonal demand. India is a country where there are a lot of festivals and people tend to use more and spend more money in terms of maybe gifts or buying themselves something new in those particular seasons as well. There are seasons, there are times when people tend to not buy during those particular time phases, but there is time like maybe Diwali, etc., where people's consumption increases a lot. So, in order to make sure that during those particular months, the economy has surplus cash, not too surplus, but enough cash to make sure that no transaction that is happening is struggling because of the lack of the money in the economy. It makes sure that the economy has stable amount of money. RBI also keeps a strategic reserve. It maintains an emergency buffer stocks to handle unexpected demand surges or disruption in the banking system. This might be in case of extreme crisis. Any downside is taken care with the help of the strategic reserve that the RBI holds. Now, let's talk in number terms. Existing currency in circulation, that is the currency that is already flowing through the economy. This is the number. Additional demand, when that it is dependent again on economic growth. If the economy is growing more, inflows are coming from the foreign, and inflows needs to be converted into currency, that so that that currency can finally be used in that domestic environment. Currencies need to be printed. Again, they are being converted from the foreign currency. More foreign reserves are entering the country. See this number, 80,000. This is for the replacement of damaged notes. 80,000 crores. This is basically 40% of all the printing. In this particular example, replacing worn out notes. It is not new currency being added in the economy, but it is the replacement of the worn out notes in the economy. Due to some scenario, due to some situation, RBI might have the need to increase the strategic reserve, so they add and print new money. So that leads to the ultimate, this particular example tends to bring in how much printing requirement there is, right? So let's take an example and understand what will happen if too much money is printed. Like I earlier said, we are using plastic bottles in a use and throw manner just because we know that enough plastic is there. We are not making bottles out of gold and throwing it, because gold has a finite value, has a finite we have finite gold available to us. That's why it's worth more. People are paying to secure that commodity. They want to hold it because gold is useful, not only for jewelries and keeping it as a collectible, but also in the structural requirement of the chips that are being produced, right? So what will happen if we keep on, let's say, what will happen if we keep on, we find out a way and we keep on producing gold, and gold is no longer a finite resource? What will happen in that scenario? Gold would be worth nothing, because everyone would be able to produce gold. At that particular time, the value of gold would be close to nothing, right? So let's say in a very adverse situation, what is happening is everybody in the economy are producing, have their own printing press and are producing money, right? Everybody has a huge stack of cash. Everybody needs to buy this particular water bottle. So it is, let's say, worth 100 rupees. Now there is only one bottle and three customers. What will happen? This person would say, I am ready to give 100, I am willing to give 1,000 rupees for this particular bottle, because he's printing his own money. He doesn't have to earn it. This person is saying, if he's giving 1,000, I'm ready to give 2,000. He doesn't care because he's printing his own money. He is willing to say it is willing to give 3,000, but the underlying value of that particular commodity still remain 100 rupees. So from this example, we can understand that printing money should be backed on or based on something. If the economy is expanding, new money needs to be created, but again it needs to be depended on something, right? So what happened with Zimbabwe was that Zimbabwe faced severe fiscal shortfalls, and what they did, rather than fixing the structural economic problems where economy was lacking, they just recklessly started to print money. They started to print money based on nothing. It was dependent on nothing. And when that happens, this examples comes in. This 100 rupees bottle would be willing to sell for 3,000 rupees. Right? This is basically inflation. Right? So in that scenario, inflation became hyperinflation because actually inflation rate exceeded 89.76 trillion percent per year. And ultimately, not surprisingly, in 2008, the currency, 2009, the currency became so worthless it was abandoned entirely. This is not a theoretical example. The similar things happen in Venezuela, Weimar Germany, Argentina, and every other country who faced economic instability because of this reckless printing of money. Right? So, how RBI is in charge of printing money? How RBI really works? It monitors inflation. This CPI, Consumer Price Index, is a very good indicator of measuring inflation. But to understand when and how much the CPI could be increased is dependent on the wholesale price index. If this wholesale price index starts to increase, we can have an example of how much CPI is gonna increase. So they are tracked continuously. Rising inflation signals needs to restrict, not expand money supply. If inflation is rising, people have more money. Stop the money supply, people would have less money, and this bargaining of giving extra cash for a commodity that is worth only 100 rupees stops happening, and the prices come back to being 100. It researches on GDP growth forecasts. It uses economic projection to anticipate how much additional currencies the growing economy will require over the coming year. Right? Digital payment trends. Due to UPI being adopted so rapidly, the demand for physical cash is falling. RBI adjusts note printing estimates to reflect India's rapidly digitalizing economy. RBI depends on the banking system data. It understands the cash withdrawal patterns, ATM replenishment rate, and the bank branch activity. It is all feeded into RBI's real time currency demand models. So, most money is never printed. When the bank approves a 50 lakh home loan, it doesn't pull physical notes from the vault. It creates a new deposit in the borrower's account electronically. Right? This new deposit is basically the new money which is electronically generated. It never existed before the demand of a loan. Right? How RBI does that? It uses repo rate. What is repo rate? It is the rate at which banks borrow funds from the RBI. If repo rate increases, cost of borrowing increases, loans becomes more expensive, people spend less. CRR is basically the share of deposits that the bank must hold with RBI. If this increases, this is the cash reserve ratio. If this increases, more money needs to be in the walls of RBI than in the economy. So, the supply of money in the economy slows down, and hence inflation can be controlled. Open market operation, buying or selling of government bonds to expand or contract the liquidity. If you are buying the government bonds, the money that you could have spent somewhere, now it's with the government. The cash flow for you is reduced, it's invested somewhere, it's stuck somewhere, right? So this reduces the supply of money. And when you are selling the government bonds, that's when you get your money and you will be able to spend. So, putting it all together, economic growth, strategic reserves, currency in circulation, seasonal demand, and damage note replacements are basically how RBI decides how much money needs to be printed and not created. Right? If there is too much currency, the inflation rises, purchasing value erodes, savings lose value, and economic instability flows. If there is too little currency, there would be shortages which disrupts commerce, rural economies suffer, growth stalls at grassroots levels. So the goal is having the just right amount. Economic activity flows smoothly, transactions are supported, growth is sustained without overheating. So most money isn't printed, it's created when banks lend money. Right? Physical notes are a very small slice of money in supply because today, with the adoption of UPI payments, the demand for physical notes has decreased dramatically. Bank lending is the only dominant mechanism which actually creates money, and that too today is done electronically at scale. RBI's real job, either through printing or through absorbing, either they are injecting Cash flows, either they are absorbing high liquidity, it's just there to manage the flow and not the press, the printing press, the mint. They are not to just print money, they are there to manage the flow of money in the economy. That's it. Thank you.